Welcome, everyone. I hope all of you are safe and healthy, and thank you for joining us this morning. Now, we all wish we could be doing this in person, but we're quite excited to share with you our views on where Carlyle is heading over the next several years. We haven't hosted an Investor Day since 2013, 1 year after we went public. Since then, a lot has been accomplished and a lot has changed. Today's Investor Day comes at a good moment in time to tell you what we're doing, how we're positioned, and why we're so excited about growth in the years to come. I'm going to share with you our strategy and our priorities, and our senior leadership team is looking forward to discussing the details underlying our plans. And I think in addition to giving you a good understanding of Carlyle and our path ahead, you'll also get a great feel for the people and culture that make Carlyle so special. So let's begin by stating that last year Carlyle delivered terrific financial results. By all measures, whether it's record FRE or record accrued carry balances or strong returns, we performed exceptionally well. And despite challenging conditions and uncertainty everywhere, we remained active and executed across a global, diverse platform, investing, realizing, and raising large amounts of capital, all in a remote environment. The strong results in 2020 reflect our attitude to coexist with all that is going on in this complex environment, and our firm's amazing ability to adapt as changes occur all around us. 2020 isn't the culmination of hard work, but rather, we believe just the beginning of continued momentum as we generate more growth in the years to come. Now, allow me to take a moment and set the stage and look back at how this journey began to get us to where we are today. Our founders were pioneers in the industry. By investing wisely, fundraising in every region of the world, establishing our brand, and shaping our culture, they built the foundation of this amazing company. Just 20 years ago, we were a relatively small DC-based firm with $4 billion in assets under management. Today, we've grown and evolved to become a global leader in private capital markets. We're a firm of 1,800 professionals around the world in 29 offices in 19 countries, managing approximately $250 billion in assets through a broad range of investment strategies across all major asset classes. And throughout this journey, our values and culture have remained true to our founders' original principles of trust, integrity, and partnership. Building on the success of our past, in the last several years, a lot of work has gone into adapting our business model and organization to position Carlyle for the future. We simplified the structure of our organization into 3 business segments that reflect the way we approach the market: private equity, private credit, and private asset portfolio solutions. In doing this, we streamlined our offerings and reduced product proliferation. We architected our private credit approach from the ground up and recruited world-class talent, which has injected new ideas and innovative thinking into our firm. We broke down organizational silos and implemented a global platform-oriented approach. By taking advantage of our deep industry specialization and institutional value creation capabilities, we can invest better while also driving operating leverage. We embraced a multi-stakeholder approach, which for all of you shareholders has meant a deliberate shift away from a historical singular focus on performance fees towards an objective to deliver more FRE and growth of distributable earnings. We transitioned the firm from a private company to a full C corporation with industry-leading governance, providing simplicity, transparency, and alignment. 1 share, 1 vote. And finally, we've accelerated our approach of building better within our portfolio, embedding and integrating our best-in-class ESG capabilities directly into our investment processes throughout the firm, thereby supporting value creation to the benefit of our portfolios, limited partners, the communities we live in, and ultimately, our shareholders. All of this work is about driving change and evolution, which has kept us quite busy over the last several years. Now, there really is no rest for the weary, because last year, in addition to navigating the complex environment, our leadership team was also hard at work creating a strategic plan to accelerate Carlyle's growth over the next 4 years. We kept it simple, and a few key principles underpin our strategic plan. Namely, we are focusing our efforts to build on and extract more value from our strengths, pursuing only those strategies that are big and scalable, and capturing operating leverage as we grow. If we can adhere to these principles and continue to invest wisely, it ought to all come together with terrific performance for all of our stakeholders. Taking a step back, in a nutshell, I am driving Carlyle to think bigger, perform better, and move faster. This is today's Carlyle. So let's now dive into the strategic plan. Big picture, there are three major priorities driving our efforts. First, we will accelerate our growth by focusing on and scaling our biggest and best platforms. There's a lot here, so please bear with me. Many of you have asked on previous earnings calls, when will your next fundraising campaign start? Well, it's now, and we've already begun. You've also asked, how much are you going to be raising? At least $130 billion over the next 4 years. That's our target. This is a critical component underlying our strategic plan, which will set the stage for investment activity and earnings growth for many years to come. As you can see on this slide, we expect roughly 50%, or about $65 billion of our fundraising dollars to come from our global private equity business. Our flagship corporate private equity funds will drive much of this growth across the United States, Europe, and Asia, targeting fund-over-fund growth of 20% or more. Our flagship U.S. real estate fund is already in the market, and we believe that its portfolio's resilience during the crisis and attractive historic returns will drive strong demand. The feedback so far is encouraging. Furthermore, the advantage of a platform approach is that we can pursue more investment strategies through our sector-driven teams, and therefore raise additional capital around growth-oriented and core return private equity strategies. Our confidence in scaling up within global private equity is grounded in our history of consistently delivering for our limited partners. In particular, we have demonstrated an ability to perform responsibly at scale, not only to raise and invest, but return significant amounts of capital through cycles. As you can see, we've invested very large amounts and realized nearly $210 billion in proceeds since inception. Responsibly managing large quantum of capital at scale, which is all about deploying across cycles and performing consistently. This is what our LPs count on us to do. In the short to medium term, markets permitting, we're anticipating making large distributions back to fund investors as exits increase and we monetize gains that we have generated in the last few years, reflected in the current record $89 billion of value in our portfolios, which sets the stage nicely for our LPs to be in a position to re-up and recycle the capital that we are returning to them back to us to fuel our growth. Pete Clare and Sandra Horbach will go into more detail about the strength of our global private equity platform and our competitive advantages which enable us to consistently deliver for our limited partners, and hopefully you'll share our confidence that we can continue to scale this business. Moving to global credit, this platform has doubled AUM in the last 5 years, despite a complete rebuild of our prior approach. And our ambition? It's to double it yet again in the next handful of years, implying we could reach $80 billion plus within the next 4 years of the strategic plan. You'll hear more from Mark Jenkins later, but our global credit segment today is a platform-driven, balanced business offering broad credit investment strategies across liquid, illiquid, and real assets. To reach our AUM ambitions, we're going to lean in and grow existing strategies like CLOs, direct lending, and opportunistic credit. Grow in adjacencies, which represent white space for us, including strategies like infrastructure and real estate credit. And over the very long term, extend our footprint and reach into developing credit markets like Asia. The growth we'd like to capture is supported by strong tailwinds. Relative to private equity, the private credit asset class is still small, only about 20% of the size of private equity. And in light of the low interest rate environment we're in, we are seeing increasingly more investors rotate from traditional liquid fixed income into private credit to do everything they can to capture more yield. Now, as a reminder, everything we do in credit is helped by the sector expertise, established history, and massive resources of our global private equity segment. Because we purpose-built this segment with a platform approach, as you see on this chart, we expect the FRE pickup will be enormous. In the past 5 years that we've doubled AUM, FRE went from $8 million to nearly $100 million. Let me take a moment here and just say, I remember on several earnings calls asking for your patience so that we could build this credit strategy in the right way. I want to thank you for that patience because I believe it's paying off. And with your continued support, we believe we are on a path to hit $200 million or more of FRE in our plan's timeframe. Now turning to our investment solutions segment, which operates under the AlpInvest brand. This segment helps our limited partners better manage their alternatives portfolios through three well-established strategies. Secondary solutions, a market driven by the maturation of the asset class, which gives LPs access to diversified and seasoned private equity portfolios. Direct investments, which supplement limited partners' traditional commitments with the benefits and efficiency of co-invest. And primary investments, which is an entry point to alternatives for LPs looking to access multiple managers on a simple, one-stop, and highly diversified basis. Over the last few years, we focused on scaling AlpInvest secondaries and co-investment businesses, and we raised over $14 billion last year alone. And what enables that type of fundraising? It's simple: investment performance. As you can see, this business has delivered terrific and consistent returns for our limited partners over time, which sets the stage nicely for AlpInvest to continue driving future growth. As the alternative asset class continues to grow and mature, portfolio solutions provided by AlpInvest will only become more in demand as more and more limited partners look for solutions and strategies to help actively manage their growing illiquid portfolios. As you've scaled these strategies, we've gone from fee-related earnings of $17 million in 2012 to $37 million in 2020 and have a plan to potentially double this level by 2024. This segment is a good example of what happens when we focus on our strengths, concentrate on just a few products that are large and scalable, and capture operating leverage. So we have our sights set on raising $130 billion of capital across all three of our major business segments based on our strong positioning and track record. What I'd also like to highlight are the attractive industry trends that provide additional support for the acceleration and scaling of our platforms. A few important observations. Let's start with the fact that we're all trying to figure out how to invest well in the current low interest rate environment. Our limited partners with long-term investment horizons are looking for all the performance they can get. I know this chart is a little busy, but as you can see, whether it's in buyouts or private lending or real estate, our industry historically outperforms public indices. And whether it's pension funds, sovereign wealth funds, family offices, or the high net worth channel, they're all seeking more private strategies to generate alpha. Given this outperformance, if the low yield environment relative to history persists, which we believe is more likely than not, we foresee sustained allocation to private markets for many years to come. Now, having more dry powder is great, but what's also happening is the opportunity set for private investing continues to grow. There is change accelerating all around us, all over the world, in all industries and in all sectors. These changes create investment opportunities for Carlyle. Regions like India and Japan are opening up to private investment. Asset classes like credit and infrastructure continue to expand. New strategies like core private equity are emerging, and opportunities to fund new business models for fast-growing and disruptive businesses, particularly in technology and healthcare, are increasing every day. Massive shifts like energy transition and sustainability have also created huge capital needs from both a growth and value perspective. And while all this is going on, entrepreneurs and high-growth companies in all industries and regions want to stay private for longer as they continue to seek out the alignment and value creation that firms like Carlyle provide. While on the other end of the spectrum, as large corporates pursue M&A or refocus on core businesses, they are shedding and divesting non-core assets that offer spin-out and carve-out opportunities for us. No doubt valuations may be high in this current environment. Uncertainty is everywhere. Markets are volatile, and generating growth is always hard. But there certainly is no shortage of opportunity. Within the investor community, we are seeing the largest LPs wanting to consolidate their relationships and concentrate commitments with fewer GPs who can deploy and perform at scale. Given our track record of performing across cycles, we believe we are well positioned to benefit as LPs continue to demand more from less, meaning broader and larger, more strategic relationships with fewer GPs. Demonstrating this point, and as you'll hear from Nathan Urquhart later, at Carlyle, 80% of commitments from our largest limited partners come from those with exposure to 4 or more of our funds. And finally, as demonstrated by our capital raising in 2020, a trusted firm and brand is an invaluable asset in a virtual fundraising environment. So we feel pretty good that our business segments, their performance, and industry trends set us up nicely to execute against the first strategic priority. Now let's move to the second strategic priority, namely, doing a better job of capturing adjacencies. I want to reiterate our intention to build off of strength, not diluting or proliferating our strategies, and focusing on big, scalable markets. This lens applies not just to our existing businesses, but to new opportunities as well. So with that in mind, let me touch on just 2 specific areas where we are investing a lot of time and attention: capital markets and insurance solutions through our Fortitude platform. We have a real opportunity to capture significant revenue through our newly integrated capital markets business. Capital markets is about as adjacent as it gets to our main business. In the last 5 years alone, we've generated nearly $300 billion of issuance in Carlyle-related deals. We have positioned our capital markets professionals to provide placement services on capital markets transactions and to participate in securities underwritings and loan syndications, currently focused on transactions involving Carlyle and our portfolio companies. Internally, we've worked over the past few years to ensure that our capital markets team can assist our investment professionals and has access to deal flow across the firm. We believe that capturing more fees from this activity is readily achievable. Historically, Carlyle and our portfolio companies have paid third-party firms aggregate fees, in some years approaching $1 billion, for investment banking and other capital market services. All we are doing here is capturing a small percentage of these fees, perhaps 10 to 20% over time, which is already an established practice in the industry. As deal, M&A, and exit activity continues to pick up, and as our LP platform scales and grows in AUM, we would fully expect our capital markets business to reflect that underlying growth. Kurt's going to go into this in more detail on how we see this area developing and the profitability growing. Now, to be clear, we do not want to become an investment bank. We are and always will be an investment firm. But our capital markets team can be very effective in assisting Carlyle portfolio companies with their financing needs, thereby earning a portion of fees attributable to those financings. Like I said, this business is about as adjacent as it gets. The second very focused way we can expand is through our permanent capital insurance solutions platform. First of all, Fortitude is living up to expectations and performing quite well. The rotation of assets has begun into Carlyle funds. $4.7 billion has already been invested or committed, which we expect will soon increase to $6 billion in commitments. These commitments are long-dated and sticky in nature, meaning we expect these assets to be maintained at Carlyle for some time. These investments have been broad-based and deployed across the full spectrum of Carlyle's product offerings, with commitments to over 25 products across all of our segments. Also on track are the multiple revenue streams Carlyle derives from this platform. Management fees on our Fortitude co-investment vehicle and standard economics on the assets rotated into Carlyle products are generating approximately $50 million in annual fees. And we're currently benefiting from attractive returns on our balance sheet investment in Fortitude, about 15% annual return on equity on our $465 million balance sheet investment. Importantly, the very complicated carve-out was completed successfully to establish a standalone business. This platform is now in place, fully operational, and we are ready to drive future growth at Fortitude through acquisitions as well as new reinsurance activity. The growth will be lumpy and episodic, but we are working hard on a strong pipeline of reinsurance and M&A transactions in the market. And please remember, the market size Fortitude can pursue is massive, with an estimated $2 trillion of legacy liabilities on insurance company balance sheets that are looking for a home. While our activity is understandably neither projectable nor predictable, we do expect to consummate several deals in the coming years. I asked for the same patience you gave us as we rebuilt our credit platform, because we intend to build our insurance-focused platform in the right way. Similar to what I said about our capital markets initiative, just to be clear, we do not want to become an insurance company, but rather we are seeking to extend and grow our investment management capabilities and solutions into the insurance sector. Before moving on, just a general comment about how we are thinking about M&A to drive external growth. As our capital base grows from retained earnings, we'll be looking for opportunistic, strategic acquisitions that are a good fit with our organization and where buying makes sense versus building. What might interest us in the future? Again, first and foremost, it must meet the same criteria we are using to manage our existing business. It plays off our strengths, it's in a big market, and it's scalable. For example, opportunities to be a strategic consolidator like we did in the CLO business during the last great financial crisis. Opportunities that give us more permanent capital, as we did with Fortitude, where we can establish even more recurring and predictable FRE base and secure long-term asset management contracts. And opportunities to build our capabilities in a strategic way, like we did, quite frankly, with AlpInvest in 2011, or more recently in 2018 with Carlyle Aviation. Anything we do would need to be accretive, a good cultural fit, drive FRE on a recurring basis, and have the potential to increase shareholder value over the long term in a move-the-needle kind of way. So we've covered accelerating our existing platforms and capturing adjacencies. Now let me describe the third strategic priority, continuing to institutionalize the firm. This can mean a lot of things, but for us, this means first, more disciplined focus on expenses and managing ourselves better, ensuring we're not only effective, but efficient. We are committed to continue driving FRE and expanding our margins as we grow. Kurt will provide more details on our ability to achieve 40% margins by 2024, which is a huge improvement from where we were just a few short years ago. Now, while we are enthusiastic about this goal, we do not foresee Carlyle becoming the low-cost player in the industry. What we do want to be is the most effective organization at driving strong investment returns and DE over time via our deep global platform and diversified business composition and product mix, which does not necessarily equate to being the firm with the highest FRE margins in the industry. Second, bringing together best-in-class management and leaders to drive our firm forward. We've already started this effort, and over the last several years, we've added key talent across the firm, introducing external views to complement homegrown leaders. Nearly 30% of our partners and managing directors joined Carlyle in just the last 5 years, and nearly 30% have been with Carlyle for 15 years or more. This combination of proven Carlyle track record with new perspectives provides us with a very strong team to drive our strategic plan. Third, execution is all about alignment, which is why we put in place stock-based compensation with vesting linked to the long-term timeframe of the plan and direct links to achieving defined growth and FRE targets, closely aligning success for our leadership with success in executing and attaining Carlyle's objectives. Fourth, we are continuing to shape and build the culture that makes Carlyle so special. We are widely recognized as a leader in our industry with respect to diversity, equity, and inclusion. We have invested in this because we know it makes us the best at the most critical thing we do every day, making important judgments. We understand the fundamental value of an inclusive culture that fosters diversity of experiences and sharing of all perspectives so that we can make the best decisions possible every day. We are committed to continuing our leadership on this front. And finally, while we are already perceived as a leader in the industry, we are doubling down to do even more in ESG. At Carlyle, ESG and impact are not a product or fund, but a culturally embedded approach that is integrated into all of our investment processes for creating long-term growth and sustainable value. To us, better businesses have 5 key dimensions: diverse and inclusive teams, engaged employees, sustainable growth, climate resilience, and community ties. It's important to track, report on, and create alignment with these objectives, which is why we're so pleased to have announced last week an industry-first financing facility for our private equity funds that is linked to achieving portfolio company board diversity objectives. I'm excited for Meg Starr and Cara Helander to walk you through the ways we are driving value across our portfolios, what we are doing to make ourselves and our companies better, and where we see opportunity going forward. So, what's the punchline to all of this? Well, when you combine all of the pieces underlying our plan together, accelerating our largest platforms, capturing adjacencies, and continuing to institutionalize the firm, we believe by 2024, we can achieve $1.6 billion in DE, comprised of $800 million in FRE and another $800 million in net realized performance fees. The ramp in DE is expected to stay flat or gradually start to increase this year, but the slope ought to really start to accelerate in 2022 and beyond. This would also mean FRE margins expanding from 30% to 40%. Of course, there will be challenges and issues we must manage along the way as the world continues to change and be disrupted. After all, markets could correct significantly or the real economy could stall. But the past year has demonstrated that Carlyle is resilient and adaptable, and that our global diversified platform can adjust and responsibly capture opportunity in complex environments. No doubt the environment is challenging as we must navigate uncertainty, high valuations, and uneven economic recovery. But I believe Carlyle is well positioned to invest, deploy, and create value on behalf of our limited partners, who turn to us in good times and bad as a trusted pair of hands to responsibly manage their capital with a long-term perspective. Our historic performance, and certainly 2020, demonstrate our ability to adapt, shift, and pivot to the most attractive regions, investment strategies, asset classes, and industry sectors as we seek to navigate this complex environment we all find ourselves in. So let me wrap things up with some concluding thoughts. A lot of work has gone into adapting our business model and changing our organization to strengthen Carlyle for years to come. We believe 2020 was just the beginning of some great results. Moving forward, we're going to keep it simple and stick to a few core principles that run throughout the 3 priorities of our strategic plan to drive earnings growth. Industry trends should be helpful to our ambitions, and we're grateful to be well positioned with our limited partners. As we build better in everything we do in an aligned way, we are executing as one firm, remaining grounded and centered because of values that have been with us from the very beginning. And finally, we'll always stay true to who we are, a global investment firm creating value over the long term on behalf of all of our stakeholders. As I hand it over to Kurt to give you more details, I want to assure you we are thinking bigger, performing better, and moving faster to accelerate growth. This is today's Carlyle. Thank you for your time, support, and confidence. Over to you, Kurt.